Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from UK tax policy to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 compliance, provision, and modeling calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is also available to license. On this week's episode of Cross-Border Tax Talks, we're in Barcelona, Spain, at PwC's Global Tax Symposium, Europe 2025, where I'm excited to have Matt Ryan back on the podcast. Matt is PwC UK's International Tax and Treasury Network Leader and leading PwC UK's efforts on Pillar 2. Matt, welcome back to the podcast.
Hey, Doug, great to be back.
It's like a tradition here, like
of course,
in Barcelona. I think
in
it was
Barcelona,
3
years ago.
We were just talking about the model rules, Pillar 2.
Before here we are, 3 years later, still talking about the model rules and Pillar 2.
How much and how little progress we've made.
I know, it's like a vast amount of developments, but still a vast amount to be done, both on the advisory side and actually like clients complying.
You know, before I can get into Pillar 2 that I've got to start with an icebreaker, and you know that how important baseball is to me. So we finished this past month with arguably, at least in my lifetime, probably the best World Series. Just unbelievable. An 18-inning game, came down to get, you're already answering my question, I can tell by the way you said okay. An 18-inning game, it was really absolutely amazing. This rookie pitcher who started the beginning of the year at like the lowest portion of the minor leagues, worked his way up in Toronto to the big leagues and struck out 12 batters and just had these amazing Dodgers hitters flummoxed. It was a really cool, amazing World Series. Major League Baseball has been playing now for 6 years in London. In fact, my Cardinals were there a couple of years back, and I came to London. You didn't come to the game with me, but I think we did have a pint, if you remember. Does anyone in the UK care about Major League Baseball? Has this worked with MLB?
Well, it is the first I've heard that there is Major League Baseball in the UK. I guess the crowd numbers might tell a story, albeit like how many of them are Americans who live in the UK or who are visiting. So no, it hasn't quite made my radar.
Did you follow the World Series at all?
Not one little bit. So I heard you all talking about like a great game of baseball that people were watching, but I didn't know it was the World Series.
I was actually in China, and so the game started at 8 a.m. China time, and so I couldn't watch it. And not surprisingly, I was actually in meetings. But that was when there was an 18-inning game. It was like over 6 hours, which is probably, it sounds like a cricket match, right?
I'm not a huge fan of cricket, so like 6 hours with baseball doesn't rock my boat either. But I know you love it, and I can see why you do, and it does actually sound quite engaging with that rookie pitcher story. So
there's some great stories. All right, well we'll get back to Pillar 2, which is probably of much more interest to you and our listeners. A lot of discussion. We've already given a lot of airtime to the side-by-side agreement, but maybe we start with just, what are you hearing from a UK policymaker's view on Pillar 2? And, several weeks back, there's been a whole number of conferences and meetings, and there was an amazing list of policymakers at the Irish Tax Institute conference in Dublin, again, several weeks back. What are you hearing from a UK policymaker's perspective as we're all anxiously awaiting to see whether we get administrative guidance or some sort of side-by-side agreement?
Well, I think understandably we're hearing a lot of positive noises around reaching agreement still by the end of the year, because you got Tim Power from UK Treasury, who was one of the key speakers at the Dublin conference you mentioned, is a co-chair of the Inclusive Framework. So that there is a drive to reach agreement by the end of the year. But then the UK is also pointing out some of the challenges in reaching that agreement, that we have to ensure that there's checks and balances around the competitiveness of the US versus the rest of the world once the side-by-side agreement goes into play. So I firmly believe we will get something by the end of the year, but whether it's actually the detailed package or signalling of like all the positive developments in the discussion and what the final mile hurdles are to get complete early in the new year.
Yeah, and I want to unpack that. I mean, my takeaway from a lot of the press, particularly coming out of that conference, as well as a lot of other press, is that the tone has definitely shifted now, where there appears to be acceptance for, particularly in the EU, which I appreciate that you are not in the EU, but really around the globe, for those 60 countries now that have implemented Pillar 2, sort of an acceptance of the idea that guilty, or now referred to as NCTI, can and should coexist with Pillar 2. And that's obviously a huge change from what we saw, obviously, before Section 899. We've covered all that on the podcast. But even from Inclusive Framework members, and specifically the OECD, everybody appears to be working very diligently on that. The big challenge, of course, is that what do other countries want as they're trying to have these bilateral, multilateral negotiations? What else do other countries want, right? And we've heard reported that India and China, for example, are also looking for some sort of UTPR, safe harbor, carve-out for those parented groups. And there is kind of a practical issue of how much can they actually agree to, and to your point, at what level of specificity will we get before the end of the year? So one of the things that you mentioned, Tim Power, that talked about at the conference, was how could any agreement or guidance get actually incorporated into local law? And the reason that this is so important, and particularly for public companies, is that public companies have to provide, both under IFRS, US GAAP, based on enacted legislation. And I'm a little concerned as to what level of guidance we're actually going to see related to the side-by-side agreement, which of those 36 countries that had rules in 2024, can they actually bring those into law for 2026, where the UTPR safe harbor for the US gets turned off? Which of those countries can actually bring that into law? Because if it's not actually enacted into law, then companies are going to have to provide for those in their financial statements. What was Tim's point from a UK perspective, and when and how that could actually get incorporated into UK law, and when it might be effective?
Yeah, sure. So, as you say, we've talked about what level of detail you get, but even if you get a full inclusive framework agreement with all the rules agreed in it, released before Christmas, countries have to go through a process to bring that into local law. So at the moment, we have the Pillar 2 rules incorporated into UK legislation, which obviously include what has been agreed historically. And there's then the process to go through to change the law to agree the changes that are agreed as part of the side-by-side agreement. And so what that requires is the UK to kind of take the language that's in the administrative framework and then craft that into UK tax legislation, which will then need to be released, go through a consultation process, and then ultimately go through the parliamentary process. So,
which takes time.
It takes time. This is not an overnight thing. And so Tim said that, yes, the UK is going to legislate it, but you would expect that it will go through in early 2027.
Yeah, 2027.
2027. But the UK is one country where, in certain instances, you can implement legislation retrospectively. So, I understand that Tim said the intent would be the legislation is implemented with effect from 1 January 2026 in 2027. Right. And in the UK, we can do it retrospectively when it is taxpayer friendly. If it is impacting on the taxpayer adversely, then it can only be prospective, but you're reducing compliance burden and potentially cost here, and so that's obviously taxpayer favourable and can go.
Yeah, and there are a whole lot of financial accounting implications of what enacted means. It's way out of both of our areas of expertise. But it does beg the question, well, what about those other 60 countries that have brought in the legislation? Not all of them have a UTPR, but we're well over 40 at this point. And then I think with the UK legislation, you followed the model rules. You have the UTPR safe harbor, which is really the safe harbor from applying to US parented groups. But for calendar year filers, December 31st, 2025, that's over.
That's when it's gone. Yeah. Yeah.
And so that is certainly an issue. And then obviously for many US multinationals, the UK has been a popular acquisition target, as well as a holding company location. So the income inclusion rule applies. Obviously the Trump administration's position that the side-by-side agreement should not just turn off the UTPR at the US parent level, but also the income inclusion rule and UTPR to all the foreign subsidiaries, which obviously could have financial statement implications as well. So a lot of uncertainty. And I mean, Matt, my big concern is we're going to see something before the year end, but I don't think it's going to be of the level of specificity that I think we're hoping for as advisors and that the taxpayers are looking for.
No, like 100%, as I say, even when you have draft legislation, there's steps to go through until you can benefit from an accounting perspective in relation to that, based on experience to date.
Yeah, and at that same conference, I think it was the same panel that Tim was on that we read, Benjamin Angel, who's the director of for direct taxation of the European Commission, sort of raised, and this has been a popular topic of conversation for us Pillar 2 nerds, was this 1962 EU jurisprudence that could potentially allow the EU to bring that guidance into all of the member states that have enacted the UTPR. I'm certainly, neither of us are experts on EU law as well, but it did sort of beg the question for me as well, if this was jurisprudence and this was the case, then why are all these countries having to bring in that administrative guidance into each of their respective domestic legislations historically?
Absolutely, and ATAD too, and a number of the directives that have been released over the years. And yeah, I think it's fair to say that in discussions with some of our European colleagues, I think it's fair to say that there are some question marks against whether that can actually be applied in all EU countries without the local legislation.
Yeah, and during that, and there's been a lot reported on there are a number of sticky issues, is how it's been described with Pillar 2. And I just wanted to pull a couple and get your thoughts on these. And these are issues in the UK as well as everywhere. That the taxpayers are still struggling with. And I know HMRC has been in the UK. The UK policymakers have been very open, talking to advisors and taxpayers, looking for guidance, really trying to have a dialogue. But one of the first ones was JVs and popes.
Yeah.
And maybe what are some of the challenges that we're still seeing? And I think we covered this like 3 years ago.
I'm pretty sure we did.
We did,
because it was clearly going to be a problem 3 years ago, and we're realizing it's clearly a problem today.
So what is that
people
issue?
People try to comply. So just to unpack that, the partially owned parent company means there's an entity within the consolidated group that has more than 20% held by a third party, such that becomes a reporting entity for Pillar 2. But the effective tax rates of the various subsidiaries that it holds are looked at on the consolidated group basis. And so you can have publicly owned companies that are popes, where their effective tax rate of the subsidiaries is driven by the activity in its owners, in the group that it itself also consolidated into. And so there's just a challenge in getting hold of the information to be able to file the returns.
And similarly, one of the other issues that they mention is mergers and acquisitions and the data gaps there.
Yeah, I mean, you're buying an entity. There's obviously so much due diligence you can do, but you can't look at everything. You don't know what the quality of the underlying data is, what reorganizations took place within that target entity during the transitional period. So what are your asset values for Pillar 2 purposes? Has that company got purchase price adjustments that are going to continue? Do you have the data to be able to back those out? There's a number of data gap issues, as you say.
And I think it's really important that for those that are doing deals, I mean, we've been saying this on the podcast now for 3 years, that they need to request this information and this data. And this is not something that has historically been included within deals, and particularly some of the historic asset basis or some of this historical asset value information. And really important. Like this is obviously not going away, and if you've done a deal, you're going to need some of that historic information from the buyer to be able to do your Pillar 2 compliance and Pillar 2 calcs. A couple of the other issues were treatment of the transfer pricing and post-year adjustments. We don't need to dive into that. The other big one, and maybe get your thoughts, and if there's been anything from HMRC, is dispute resolution. Like, now that the UTPR is kicked in, and we've got, there are a number of taxpayers that are in the soup in the UTPR, and there are obviously very specific rules on what I refer to as the allocation key on how that UTPR gets spread. What we're seeing as we're continuing to build the Pillar 2 engine, as companies or as countries bring in those into domestic legislation, there are some inconsistencies, and so and so how does all of this get when this gets audited at some point in the future? Is there any thoughts from HMRC from a dispute resolution or any views on that?
Nothing specific coming out there. I think that the key issue, as you've touched on there, is there is no global dispute resolution mechanism. So one country can think that the Pillar 2 pie is 100 of profit to be allocated, but then because we've got differences in the UK rules versus the OECD rules, we could think the overall kind of like Pillar 2 pie is 150. And so when we ask for our slice, say it's 50%, we want 75, where you've got another country asking for like 50. Another one asking for another 50. You're like, hang on, like there is only so much to go around, and then everyone needs to get resolved. How do you treat those differences? I think there's probably some wishful thinking, or looking back and thinking, wouldn't it have been a great idea to actually have got a global agreement in relation to this before we went into the process of agreeing the rules? The first thing to get into place is the kind of overall global agreement as to how we're going to apply it.
The other thing that we've been hearing a lot about is this permanent safe harbor, and it sounds from some public comments from the OECD that we're going to see both a side-by-side agreement as well as some potential guidance on a permanent safe harbor. I have reminded folks that the transitional safe harbor does apply for the first 3 years. There's been some thoughts that maybe the transitional safe harbor will get extended another year. Even if it doesn't, that permanent safe harbor doesn't come in until 2027, which means taxpayers wouldn't even file until 29, right? Because it's the end of 27. I got to do the math on my fingers. You're faster than me. And it's like there's a lot of oxygen being soaked up on this permanent safe harbor, and that has obviously been circulated publicly. Doesn't feel as safe or as simplistic as I think many would hope.
I think that's absolutely fair based on what we've seen. You're starting from the accounts, so that sounds relatively simple. So does the CBCR safe harbor, but then there's a number of adjustments that need to be made, and it is more adjustments than you're making to the CBCR today. So there's more steps to go through, and it's some of the adjustments you're making for the full rules are going to be included within that safe harbor calculation. There'll be a safe harbor rate. They're discussing it between 17 and 20%. I'm hearing that it might be closer to 17. But then you've got an exercise to go forward and recast all your deferred tax assets at 17% and then look at the movements of those. But in looking at the movement of those, you've still got to consider the deferred tax recapture rule. And so you can see that, like, yes, on the income side, it's relatively simple. We take out excluded dividends, take out excluded gains, take a couple of income things that might be in OCI. There's not as much complexity on the income side, but all those complex adjustments in relation to tax, there's a fair proportion of them that are going to be included within that rule. Exactly.
I'm going to make a radical suggestion. If there happen to be any policymakers that listen to this, Matt, how about we make the transitional safe harbor permanent? Like, as opposed to just extending it a year, taxpayers have put in the process, they've figured out how to accelerate or are figuring out how to accelerate the country by country reporting process. I mean, we've talked to lots of taxpayers, looked at lots of these calculations, and it's like, can we make that permanent and figure out what is that appropriate rate? Is it 15, 16, 17? But just make the transitional safe harbor permanent.
I mean, that funny enough makes complete sense to me as well. Like, if you're going to extend, you're thinking about extending it anyway in anticipation of bringing in that permanent safe harbor. Well, you're extending it at the period that you're actually receiving the first set of returns, and say that you could undertake an element of due diligence in relation to, okay, I have this data, does it look sensible versus what I've received? Okay, maybe we can extend it for another year. So kind of extend it a year at a time whilst testing it and decide, do I really need a different safe harbor?
All right, so let's move on from compliance, and wanted to get your views on Section 899. Obviously, I think the G7 agreement took many of us by surprise when Congress had at least proposed the introduction of Section 899 as part of the One Big Beautiful Bill Act. The condition was that we would have a side-by-side agreement. We've already talked about some of the challenges of actually getting to a side-by-side agreement. What are you hearing from UK taxpayers when 899 was introduced? And any thoughts on where things could go, if 899 does either get reproposed or reintroduced, if the side-by-side agreement either does not have the level of detail or is not sufficient for the U.S. policymakers and specifically President Trump?
Yeah, I think in a nutshell, UK taxpayers or UK groups with US subsidiaries, investments into the US, were very happy when 899 was pulled from the bill. And so I think overall in the UK, I think probably due to the positive noises that are being made about the side-by-side agreement, and notwithstanding it's regularly coming up from various politicians or representative bodies in the US, that 899 can obviously come back in at any point in time in the future if the side-by-side agreement's not in place. But I think everyone's expecting that 899 isn't coming back on the table because we will get that side-by-side agreement, and there's a desire of I think UK businesses to have the side-by-side agreement, because they absolutely do not want 899.
I mean, we'll see how all of this plays out. But again, it's like, because we get the side-by-side agreement, if it's not enacted into law, does the U.S. policymakers then say, oh, well, this hasn't actually been enacted, and look for 899? And I mean, to the point that you were alluding, like actually getting another piece of big U.S. tax legislation through presumably some form of reconciliation process takes a lot of time too, and a lot of political capital and effort. So certainly a lot of uncertainties with there. The thing that I think that the biggest piece that I was talking to non-U.S. multinationals about Section 899 was the potential implications and changes to the BEAT, right? Of course, everybody understands the withholding tax implications. All right, we've got zero coming out generally from the U.S. to the UK. There could be additional withholding taxes, but the elimination of the BEAT thresholds was
just bringing groups that never had to worry about it into the scope of BEAT. That was mind-blowing for them in the conversations with them as to actually what they'd need to do and how it would adversely impact them.
And that's the base erosion. And that's the base erosion anti-abuse tax that potentially subjects any payments coming out of the U.S. to one of those jurisdictions to this additional BEAT tax. And we won't dive into that, but just that's something to keep an eye on. And who knows if 899 comes in, what it could look like. Do they keep the BEAT provisions in? Is it just withholding taxes? So we won't speculate. So let's move on from Pillar 2 and just get maybe some quick hits on some other UK tax updates. And let's start with the UK tax rate. Where is it, and where the UK corporate tax rate? I don't need to know about the individual tax rates. The UK corporate tax rates, where is it, and where is it potentially going?
Okay, so actually I think we will have to talk about the individual tax rates as part of this conversation. But at the moment, the UK corporate tax rate is 25%. And there was a commitment from the current government that it would stay at 25%. They released a UK corporation tax roadmap to give certainty to investors into the UK that it would be staying at 25%. So all sounds so far so good.
Yeah.
And so the reason for saying we need to bring income taxes back into the discussion is the government also made a commitment that they would keep income taxes and national insurance taxes and VAT taxes. So they would keep a number of the taxes that impact individuals at their current levels and would not increase those over the term of the Parliament. Now, those account for like about 60% of UK tax revenues. As a consequence of fiscal pressure in the UK, the Chancellor has been kind of telegraphing, putting kites up as to various tax increases, which they are no longer reinforcing that manifesto commitment that they will not increase income taxes. So I think we can see some increase in income taxes coming, but of those various 100 or so different changes to tax policies, we haven't heard anything on increasing the corporate tax rate. And so that we obviously, as part of the eliminating the kind of fiscal pressures in the UK and closing the deficit, really need investment into the UK. And corporate taxes only account for about 8% of the overall tax take. So that there may be an element in there of thinking, well, we've signalled it's not going to move for stability reasons for investment in the UK, and we really need that investment in the UK. So let's leave that untouched. So, but we will have to wait until the end of the month when we have the UK budget.
All right, we'll keep an eye on that. What about the UK digital services tax?
So the UK position in relation to the digital services tax is that it is just temporary in the UK until we reach agreement in relation to Pillar 1. So there is currently no proposed change in relation to the digital services tax in the UK.
And that kind of flew under the radar with the trade discussions and negotiations between the UK and the US, which took me a little by surprise.
Oh, I was very much surprised. I've lost a personal bet on that, where I had bet that there would be pressure on the UK to eliminate its DST as part of the UK-US trade agreements, but it's just apparently dropped.
Well, keep your head down, because who knows how things could change on that. All right, maybe we'll leave with what I'm hoping might be some optimistic news for taxpayers. Is there any talk or discussion in the UK on simplification? I asked Will Morris in a prior podcast about the EU, and I asked, is EU simplification an oxymoron from a tax perspective? Obviously, with Pillar 2, the UK has CFC regimes, your own complex set of anti-arbitrage and anti-hybrid rules. Are there any talks about now, with Pillar 2 coming into effect and all the detail, really trying to reconcile some of those historic provisions that were intended to focus on base erosion with the Pillar 2 rules?
No. But you said we can't close on a negative,
all
so
right.
I think the positive would be never say never. That there are ongoing discussions around simplifying the tax code. There is an acknowledgement that it has become particularly complicated, but in discussions, and we may have covered this about 3 years ago at the time when all these rules were announced, we have had discussions with HMRC and HM Treasury around whether we could get rid of the UK CFC rules and the hybrid rules. Now we have Pillar 2, but they pointed out that there are a large proportion of UK taxpayers are actually below the Pillar 2 threshold, and so you don't want a two-tier system where you only apply CFC rules to one group of payers and you don't apply them to another, but then you're saying, hang on, but isn't that how Pillar 2 works?
I think that is a perfect way to end things, Matt, because it is the way Pillar 2 works. All right, well, Matt, always great hearing from you. It'll be fascinating to see how all of this continues to transpire on the side-by-side agreement. Very interested to see how the UK can bring this into law, and particularly this comment about 2027 and potential retroactivity and all of the financial statement implications and practical implications of that. When we get more guidance on that, look forward to having you back on.
Yeah, happy to come back.
All right. So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Matt Ryan, PwC UK's International Tax Services and Treasury Leader and UK Pillar 2 Leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.